Warren Buffett is currently sitting on one of the largest cash positions in the history of Berkshire Hathaway. Hundreds of billions of dollars. Cash, not stocks, not aggressive acquisitions. Cash. That decision alone should make investors pause, because Buffett is known for one simple philosophy: be greedy when others are fearful. But right now, something different is happening. Instead of aggressively buying markets, the most experienced investor in modern history is holding enormous liquidity. And he is not the only one. Across corporate America, something strange has been happening quietly. CEOs are selling shares. Executives are reducing exposure. Insiders are stepping back from aggressive buying. And perhaps more importantly, many of them have stopped talking about the future with the same confidence they showed during expansion. Because when markets feel unstoppable, executives become loud. They announce bold plans. They promise growth. They highlight opportunity. Optimism fills earnings calls. But when uncertainty rises, the tone changes. Executives become careful. Statements become shorter. Confidence becomes quieter. And silence becomes a signal. Now understand something important. Corporate executives have access to information most investors never see. They understand their supply chains. They see demand changes early. They understand debt exposure. They track liquidity conditions inside their companies. When those executives begin acting cautiously, they are reacting to something real, something structural. Now, look at what has happened historically before major market stress events. Insider selling increases. Cash balances rise. Executives avoid aggressive commitments, and corporate messaging becomes defensive. This does not mean a crash happens immediately, but it does signal awareness of rising risk. Executives do not panic publicly, but they reposition privately, and those private moves often reveal more than public statements ever could. Now compare that behavior to retail investors. Retail investors often become most confident near market peaks, when prices are rising quickly, when headlines celebrate record highs, when social media is full of success stories. Confidence expands rapidly. But executives see the same market through a different lens. They do not only see price, they see cost pressure. They see slowing orders. They see tightening credit. They see the financial plumbing behind the economy. And when those signals begin changing, their behavior changes first. Now consider why silence matters so much. During strong cycles, executives want to attract investors. They want attention. They want optimism. But during uncertain cycles, executives avoid creating expectations they may not be able to meet. They become conservative with communication, because overpromising during instability can destroy credibility. So they step back, they speak less, they move cautiously. And careful investors notice this shift, because silence in corporate leadership often signals internal caution. Now combine this signal with what we have already discussed in previous videos. Central banks accumulating gold, institutions raising liquidity, margin call risks increasing as leverage builds. These signals do not exist independently. They connect, they form a pattern. And patterns reveal preparation. When multiple powerful actors begin behaving defensively at the same time, it means something deeper may be developing beneath market optimism. That does not guarantee collapse tomorrow, but it does suggest experienced players are preparing for instability. Preparation is rarely loud. Preparation is quiet. Cash balances grow quietly. Exposure decreases quietly. Risk is reduced quietly. But the implications of those quiet moves can become very loud later. Because if executives are preparing for slower growth, markets eventually notice. If insiders are reducing exposure, prices eventually adjust. And if corporate caution spreads across industries, confidence weakens. Confidence is the fuel of markets. When confidence fades, volatility grows. And when volatility grows, leverage becomes dangerous. This is why experienced investors watch insider behavior closely. Not because insiders always predict crashes, but because insiders reveal positioning before narratives change. By the time narratives change, markets have often already moved. This is the same pattern repeated across cycles. Quiet repositioning, then sudden realization, then rapid adjustment. Now ask yourself a simple question. If the people running the largest companies in the world are becoming more cautious, what does that suggest about the economic environment they see forming? And if they are quietly preparing for uncertainty, should investors ignore those signals, or should they start paying closer attention? Because history shows something remarkable. When corporate leaders grow quiet during market euphoria, instability often follows soon after. And the investors who recognize that shift early gain something extremely valuable. Time. Time to prepare. Time to adjust. Time to avoid being trapped when volatility arrives. Because once markets begin reacting, preparation becomes impossible. Decisions must be made instantly. And instant decisions during fear rarely produce good outcomes. Understanding signals before panic spreads is one of the greatest advantages any investor can have. And right now, several of those signals are beginning to appear again. Jamie Dimon recently warned that economic risks remain elevated even as markets appear calm. When leaders of the largest financial institutions begin speaking cautiously, investors should listen carefully, because these individuals sit at the center of the financial system. They see liquidity flows before most investors do. They see loan demand. They see credit stress. They see how corporations are managing debt and cash. When their tone shifts from confidence to caution, it often reflects signals forming beneath the surface, signals that do not appear immediately in stock prices. This is why insider behavior matters so much during late market cycles. Executives do not need to predict the future perfectly. They only need to recognize when risk is increasing, and when risk rises, their behavior changes. Now look at the structure of insider activity. Corporate insiders are allowed to buy and sell shares in their own companies, but those transactions are reported publicly. That means investors can track when executives are buying aggressively and when they are selling aggressively. Across many historical cycles, insider selling tends to increase when markets approach elevated valuations. Executives understand when their companies are trading above realistic expectations, and when valuations stretch too far, many insiders begin taking profits. That does not mean their companies will collapse, but it does reveal something important. They believe the current price represents a good opportunity to reduce exposure. Now consider what that means in the broader market context. If executives across multiple industries begin reducing exposure at the same time, it suggests something larger is happening. It suggests corporate leaders see rising uncertainty. Uncertainty about demand, uncertainty about economic growth, uncertainty about credit conditions. Retail investors often interpret insider selling incorrectly. They assume executives know a crash is coming immediately. That is not always true. What insider selling often signals is something more subtle. Executives believe risk is rising faster than reward. And when that happens, cautious positioning begins. Now look at the contrast between insider behavior and retail behavior. Retail investors often increase exposure when markets feel safest, when prices are rising steadily, when volatility disappears, when headlines celebrate record highs. But executives operate differently. They know calm markets often hide growing fragility. During calm periods, leverage expands, risk accumulates, confidence becomes excessive. And excessive confidence often appears near the end of expansion cycles. This is why experienced investors study insider activity closely. Not because insiders always predict exact turning points, but because insiders often recognize when the environment is becoming unstable. Now, combine insider caution with another important signal: corporate cash levels. When companies expect strong growth opportunities, they invest aggressively. They expand operations. They acquire competitors. They launch ambitious projects. But when uncertainty rises, companies become conservative. They increase cash reserves. They delay expansion. They protect liquidity. This defensive positioning often appears long before economic slowdown becomes visible in official data, because executives experience demand changes before economists publish reports. They see slowing orders. They see customers reducing spending. They see supply chain stress. And those signals influence how companies allocate capital. Now imagine what happens when several large corporations begin behaving this way simultaneously. Investment slows, hiring slows, expansion slows, economic momentum weakens gradually. But markets do not always notice immediately, because markets respond first to liquidity and optimism can persist even when structural conditions begin weakening. That gap between perception and reality creates vulnerability, because when markets eventually recognize the change, the adjustment can happen quickly, prices move rapidly, confidence evaporates, and volatility returns. This is the environment experienced investors prepare for. They do not wait for panic headlines. They observe behavior changes among those closest to the economic machinery. Central banks adjusting reserves, institutions increasing liquidity, executives reducing exposure, corporate messaging becoming cautious. Each signal alone may appear insignificant, but together they create a pattern of preparation. Preparation does not guarantee crisis, but it signals awareness of risk, and awareness of risk changes positioning. Now consider the psychology of late cycle markets. During expansion, everyone believes growth will continue indefinitely. Success stories dominate financial media. Speculation becomes normalized. Risk management appears unnecessary. But experienced investors remember something important. Every expansion eventually encounters limits. Debt reaches saturation. Liquidity tightens. Confidence weakens. And when that shift begins, the environment changes rapidly. This is why silence from executives matters, because silence often reflects caution, and caution often appears before instability. Retail investors may not notice immediately, but the signals exist. They exist in balance sheets, they exist in insider transactions, they exist in corporate cash reserves, and they exist in the tone of those responsible for guiding the largest companies in the world. Understanding those signals provides something extremely valuable: perspective. Perspective allows investors to recognize when markets may be entering a more fragile phase. And fragility changes strategy. It encourages patience, it encourages liquidity, it encourages preparation instead of excitement. Because when volatility eventually returns, those prepared early gain the greatest advantage. They are not forced to react, they are ready to act. And once markets begin adjusting, that difference becomes enormous. Because the next phase of the cycle rarely begins quietly. It often begins with something dramatic, a policy shift, a credit event, a liquidity shock. And when that moment arrives, the quiet preparation we discussed in this arc suddenly becomes very important. Because those who prepared early will recognize what is happening immediately, while everyone else will still be trying to understand why markets change so quickly. And that is when the next stage of the cycle begins. The stage where policy decisions start determining which assets survive and which assets struggle. Because when instability rises, markets no longer move only on fundamentals. They begin moving on power. And power in financial markets ultimately comes from policy. Most people only start paying attention when markets are already collapsing. But by that point, the most important moves have already happened. Preparation always happens quietly. And the investors who understand these signals early are the ones who stay ahead when volatility returns. If you want clear explanations of the hidden forces moving markets, the signals institutions watch before everyone else notices. Subscribe to the channel, because the next videos will break down the playbook behind major financial cycles. And understanding that playbook may change how you see markets forever.